All right, Mike, thanks for coming on to the KREIA show here. I don't know if it's a KREIA show, but
It is a KREIA show
it,
now.
it is a KREIA show. So, Mike Fallot with Lending wanted to introduce you to some of the newer members at KREIA that may not be aware of you and Lending. So, why don't you tell us a little bit about your company and how you got started and
Sure.
all that kind of stuff?
Sure. Well, thanks for that, Eric, and great to be with you here today. Lending is a private lender based here in Louisville, and we provide fix and flip financing to real estate investors throughout the greater Louisville area and a couple of other markets as well. We have been in business since 2005, so we've seen a lot of interesting things happen over the years.
Sure.
We're a direct lender, which means that we make our decisions and we fund our loans directly. There's lots of different types of lenders out there. We happen to be a direct local lender.
Okay. And was Lending your first kind of foray into real estate, or did you get started somewhere else?
It was actually, I had bought some rental properties early on in life and had always been interested in real estate. And then in 2005 and 6 and 7 had an opportunity to get involved with this business. It started kind of slowly as a part-time gig with some friends and my business partner Jerry, who was loaning money out of his checkbook to those people.
Yeah.
And it was decided to go ahead and create a business entity at that time and start loaning money to investors and actually create a business model out of it.
So 2005 was a similar time to what we have today, when there was just gangbusters market going crazy, builders building everything they could, and then 2007, 2008 happened. Can you tell us a little bit about kind of how your business functioned and moved through that challenging period?
Those were interesting times because in 2005 was kind of the peak of the market. From 1990 through 2007, there was a massive home building effort. Every year, the number of houses built exceeded the prior year. And the subprime crisis actually started in the late 90s, and that fueled kind of the last bit of that home construction from 2004 through 2007. And that bubble burst in 2007, as we all know, and that 7 to 10 year carnage of getting rid of the excess inventory, selling off mortgages that had gone through foreclosure, all of that happened and really caused a lot of chaos in the marketplace. So we've struggled through, but we made it through those times. There were still people flipping. There were still opportunities during that period of time. And starting around 2013, 2014, the supply of houses had dropped precipitously because they hadn't been building new houses much since 2006, 2007.
Yeah.
So the market began to pick up steam again in 2013. We ramped operations back up then in a significant way and have been riding that wave upward since then.
Yeah, I personally, my first house I bought was in 2005, and I tried to sell it in the spring of 2008, and it didn't go very well for me. So that ended up turning into a rental property that took me probably another 10 years to divest from.
Well, I think in 2006, 2007, the average days on market was a year back then. So people that were trying to flip a house, by definition, you really couldn't make any money, because if it took you 3 months to fix it up, it was going to be on the market for a year. Most of them just couldn't sustain it. So during that period of time, most investors that were trying to flip ended up converting their properties into rental properties, renting them out. We did that with some of the properties we had. We encouraged our investors to do it. We got long-term financing for them, rode out that wave, and then as prices came back up, people started to sell their houses.
So I'm curious kind of how your interest rates that you charge to your lenders has changed over the last, since then, since the 2005 market. I mean, has it been a significant difference, or?
Not really. The private lending hard money rates have been consistently in the kind of the 12% range, whether you charge points or don't charge points. But if you look at the total cost of funds, that's kind of built into almost like a real estate commission in terms of that's kind of been a standard. Different lenders do different things to make it look different. They might charge a lower interest rate but add points and have different fees and things. But our rates haven't really changed a whole lot. We charge different rates depending on a borrower's experience and the volume of business that they do with us. So we're a little more proactive in that regard in terms of adjusting rates and responding to different borrowers.
So just as an example today, if somebody was a brand new investor, doesn't have any experience with real estate, are they really your type of client, or do you want somebody with a little bit of experience at least?
Well, so we look at kind of two buckets of information about a prospective borrower that help us guide us in terms of making a decision. One is experience, and that's how much of that experience we can actually see. It's actually been demonstrated. So if somebody that's flipped a house that's been on MLS, we can look at the pictures. We can see how long it was on the market. We can see what it sold for. So we can really validate what their experience is by seeing that. Some investors have other experience. They might have been a general contractor on a variety of projects. They might have been a real estate agent. They might have been a landlord. And we can't really see as well exactly how that experience transitions or transforms into an actual finished product. But so we look at experience, and then we also look at financial qualifications. Experience is the most important. Financial qualifications are not as important. Unless there is no experience, then financial qualifications are more important.
Yeah.
So we do work with new investors. It's in today's market, I think it's much more difficult for a new investor to get into the real estate market because most of the deals are off-market deals. And so the sellers are looking for a qualified investor that has financing to make a decision immediately, which makes it difficult for an inexperienced investor to try to figure out what's my rehab budget.
Yeah.
Do I have a contractor lined up? Do I have my money lined up? So the selling conditions don't really favor new investors right now. So we encourage them to go to KREIA, for example, and get educated. It's a lot easier way to get hydrated in the real estate market by drinking from KREIA than it is drinking from a fire hose.
Sure.
in a new flip that you get into by yourself.
Yeah. So on that kind of same line of thought, I know a lot of these off-market deals are being sourced and found by these wholesalers who are hunting these deals. And they're, when I got into the game back in 2008, it was kind of a different strategy than it is today. And the guys today are getting very creative. They're hustling a lot harder than I've seen people in the past, and they're still scooping up, dozens and dozens of deals, surprisingly still in this market. And you would think that, sellers would understand that, my gosh, there's hardly anything on the market. I could just, put this out with an agent. But why do you think there's still that many wholesale deals that are going on? Because I know that you fund wholesalers deals as well. Why do you think that continues to be such a good avenue for new investors to get into and do wholesaling? And why would a seller go that route rather than just put it on the market?
Well, that's a good question. My sense is that most people have grown up with the understanding that the realtor and the multiple listing market and the on-market traditional markets are the way to sell real estate. Many people are not educated about the off-market process. That's relatively new.
Yeah.
And I think the infusion of technology into that has really supercharged that on one side of it. I think the other side of it is that we are in a huge housing shortage, where estimates are anywhere from 2.5 million to 3.5 million houses short in the United States as a whole. And on average, I think we construct maybe 1.5 million houses in a good year. We haven't done that since 2005. So there's a big shortage. And so the off-market deals are ones that 5 years ago nobody would have looked at. And now people are looking for every possible avenue where you can convert it into a house that you can sell. So I think the confluence of technology with that housing shortage has really fueled the wholesale market.
Okay. So you said you first started in 2005. We talked about market conditions then. And so fast forward to 2021 now, market's on fire. People getting into the market today, what do you see as the common mistakes for whether it's a wholesaler or a rehabber that's just getting into the market today? What kind of things are you seeing?
Well, the scope of rehabs has changed a lot since 2005. Back then, it was mostly cosmetic rehabs on houses that were relatively newly constructed.
Decent shape.
That where people never made a payment, it went into foreclosure, an investor would buy it, and they would put some paint and carpet in it and sell it or do a lease option. in today's world, most of the deals, the wholesale deals that are coming out, a lot of those are houses that have, need significant amounts of work. They're old. They need a new floor plan. They need new mechanicals. They need a lot of things. And so the entry point for an investor to come in to be able to tackle those kinds of challenges is much more significant than it was before.
Yeah.
And so it requires a much broader understanding of a rehab and how to get the right contractor resources to do it, how to determine what quality is in terms of paying a contractor. So the biggest issues that we see for our borrowers is that they're not really skilled enough to manage a project, and they don't know enough about some of the mechanical or structural issues. And so they can't really spot a problem until a third party that's unrelated to them comes in, a home inspector, somebody says, you got a problem.
Yeah.
And so by then it's a little too late. So certainly the bar has been raised for experience for investors, because most of them, when they go out and look at a deal, they're looking at a complex rehab on their very first deal. If you think back maybe to what you did on your first one, maybe a cosmetic one, you kind of ease into it.
Yeah.
And we have deals now where people are stepping in, and it's complex rehab from day one, and they're just not ready for that.
They're fully gutting the house. They're doing additions. They're just doing a lot more complicated things.
Right.
So what is the rehabs that you're funding, what is the average, if you have a number, an average cost of the rehab that you're seeing, and then like an average sell price, an ARV price, after repair value price?
Sure. So I would say on average, about 60% of our borrowers are what we would consider a professional grade investor. And that is, they've done 10 or more flips over the last couple of years. They have, more likely than not, they have a dedicated crew that works for them, that does the work. So they're very well prepared to take those challenges on. In those cases, most of those rehabs, the cost of the rehab is way over 50% of the purchase price of the house.
Okay.
So that would make it a kind of what we would consider a complex rehab. The average selling price for those houses in our portfolio is going to be right around $200,000. That's the market that's the biggest piece of the market. If you look at the pie, that's the biggest piece. So we like to be in that space because it makes it easier to sell. The buyers for those houses are easier to sell to. They're less discriminating about the finishes and some of the other features that might be in the house. And then the end use of the property has really changed dramatically from where it was in '05, where it was pretty much just flipping. Now rentals are a large part of the business. Turnkey rentals is a large part of the business. And then new construction and bridge loans is also a growing sector of our business. So a lot of deals that in prior years would have been a good fit for a flip because of the margin. That margin has shrunk now, but they'll convert that into a rental where they can make their margin over a longer period of time, or a turnkey rental where they can get their cash out very quickly and convert it into a good asset.
Good. So the thoughts on today's market, low inventory, high selling prices. I think the average, you mentioned 200,000 is kind of your average ARV that you're seeing, but I think the average price sold in our market is more like 240, 250, which again, compared to 12 years ago, is about $100,000 more than it was. Where do you think we're going here in the next 5 or 10 years? And what's your thoughts on where we're at right now?
Well, we've never been very good at predicting, so we try to be better at preparing. So I'll kind of preface that with that. The housing shortage, I think, is the single biggest factor that's underpinning the overall market, that there's just not enough houses out there for all the people that want to buy them. Many of the millennials are now into the family formation stage where they desperately want to have a house, right?
Yep.
And so they are in the market looking for houses. Many in that category have the wherewithal and the means to pay for a nice house.
Yep.
They're dual income families. They're making good money. So that category is really driving a lot of the market right now from what we've seen.
New construction?
Some new construction, but a lot of it is wanting houses that are renovated and in good shape where they don't have a lot of expenditures or home repairs to do.
They want it ready to go.
They want it ready to go. The do-it-yourselfer generation is kind of waned out on that side of it. They want to have a house that's in good shape with no monetary requirements over the future for repairs and no time on their part to do that. The interest rate environment's been favorable. If you look at the long-term trends on interest rates for residential mortgages, it's a downward trend from 2007 coming all the way into where we are right now with a very steep drop over the last 12 months or so. The government is buying 50% of the mortgages right now. They have been for quite a while, and it looks like they pledge to continue to that. So there's plenty of money for people to get mortgages. Nobody gets turned away because the mortgage lender says, sorry, we're out of money. There's always plenty of money because the government's on the other side of that, buying those mortgages and keeps those rates low. So I think that side, the Fed has promised for the next 2 years to keep interest rates low. They'll bounce around a little bit in the housing market, but I don't think we'll see a big increase on that side. Housing overall is relatively affordable compared to what it has been over the last 10 years because interest rates are so low, and that's such a big component of the carrying cost of a house.
Sure.
So those factors are good. The unknowns are, the geopolitical, the housing shortage will get more attention of the governments at some point, and they'll come up with some solutions for that, which will likely cause a little bit of chaos in the housing market. I don't know what they'll be, but they always seem to have.
Whenever the government steps
there'll be a
in,
solution for that.
Yeah, whether it's a good solution or not.
Yeah. So investors are at the front lines right now. Probably one of the most significant issues facing the American economy, which is building more houses.
Yeah.
When we needed ventilators for the pandemic, they turned to General Motors. When they're looking for houses, home builders can only build so many new houses. It's really on the backs of the investors to rebuild that housing inventory.
Well, the other thing with builders, we have a business that's highly in the building new construction industry, and for the last several years, and even more so now, is the shortage of materials.
Right.
Before it was a shortage of labor after the crash, and now for the last several years, it's been a shortage of materials. And when when COVID hit and the manufacturing plants shut down and the refining mills,
Right.
the tariff for the Canadian lumber, it just kind of snowballed, and so now you've got the price of wood has gone up exponentially. The price of steel is going up a lot, and so builders are trying to continue to find ways to save money on these materials, but you still have to build houses more or less the same way. There's codes that you have to comply with, and it's challenging. So it raises
Right.
the price of all those new construction houses with the price of the materials going up.
Right. Well, and I think where investors have an advantage is that they can, particularly ones that have a crew, have their own construction crews, they can buy a house and rehab it and have it finished on the market in 30 to 60 days in many cases. So that reduces their exposure to some of the cyclical things that might happen with government intervention, interest rates. Whereas a new home builder that buys 200 lots in his building, he's committed for 2, 3, 4 years or whatever, and the market changes on him. So that part of the market that's a struggle, the new home construction, both in the price point, because it's hard to make money building houses that sell for less than $250,000. It can be done, but it's just harder. It's a lot easier to build them at $400,000. But that doesn't suit a lot of what the market is looking for, particularly in our region.
So to that same point, we're seeing, and I'm sure you're seeing, a lot of new construction in infill lots in Shelby Park and in some places near downtown and things like that. Because the lots are still relatively inexpensive.
Right.
These owners have held these lots for years and just never did anything with it. And now the cost of a new construction warrants, or the value of a new construction home warrants them actually putting a new house on those lots. So I believe you guys have done loans like that as well.
Yeah, so the urban infill where there's already a lot, there's utilities to the lot.
It's already all there.
You don't have to, the
No
zoning is
development
done. You might have some setback issues that you have to get approved, but you can really move a lot quicker on an urban infill than if you're out doing a suburban, a 200-acre plat where you got to put in roads and sewers, and you got to go to a committee and get approval and put. So those things are much more difficult, and there's a lot more cost up front versus the urban infill lots. If somebody, most of our borrowers that do new construction, they find it actually easier to do a new build than a complex rehab because you know what you're getting into.
Yep.
You can buy your lumber package, and once you get past the foundation, it's basically a very simple flip.
You don't have surprises opening up walls and
Right.
missing plumbing or electric or framing damage or
Exactly.
all those kind of surprises you don't like. And you do invest yourself as well, right?
Yeah, not as much over the last couple of years because we've been very busy with the lending business, but we've done some flips. My wife and I have done several flips. We have some long-term rentals, some short-term rentals.
So what's you've got a lot of good experience both on the lending side and the investing side personally. Thinking back from when you started, what would be your best advice for somebody getting started, and what would you say biggest thing to avoid?
So I think the best thing that any investor can do, and I give this advice to myself as well, is to be educated. The real estate market is changing all the time, and nobody has enough contacts or resources to absorb all the information. But the more people that you know, and there's a lot of smart people in KREIA, the more investors that you know, the more connected you are, the faster you can pivot your operation to being at the front end of where the market is going to be. Again, we're not very good predictors of anything, but we're pretty good at picking up clues and looking and seeing. So I think for investors, it's network and find a number of good people in all the sort, whether it's a general contractor, a lender, a title person, people that are connected with real estate. Stay on the leading edge of what's happening and stay in front of that.
Yeah, education is definitely key. Anything you'd like to leave for our KREIA members or anybody else that may be watching this in the future?
Well, just that the KREIA is a really great resource. We've been involved with it for a number of years, and we're pleased to be the platinum sponsor of KREIA. We've met a lot of great people through KREIA. I think it's not just education; it's networking and friendship.
Sure.
And so I would really encourage for the value. I don't think there's anything better than KREIA for real estate investors. And I don't care whether you're a brand new investor or a 25-year investor, that you can learn a lot and get a lot from KREIA.
Yeah, and if you think that you've learned everything, then you probably should look in the mirror because there's something.
That's right.
There's something there. You can always learn something from somebody.
Right.
So.
The more you go, the more you realize, the less you know, and the more you need to learn. So it's a constantly evolving market, and it takes a lot to stay up with it.
So how can folks get a hold of you, Mike, here at MM Lending?
So you can reach us at MM Lending. You can call us at 502-400-3012, or you can jump on our website at mmlending.com, or you can email me at mike@mmlending.
I really appreciate you sitting down and talking with me, Mike. You're always a wealth of knowledge and experience, so really appreciate it. Thank you again, and we'll catch you on the next one.
Thanks, Eric. Appreciate all you do.